Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 131. On today's episode, we're going to talk about the choppiness that the market has experienced over the past 2 weeks, talk about upcoming things we need to look out for. We got a Fed meeting coming up this week, and then also we're going to talk about boring stocks. Boring stocks that do nothing but produce great returns, allow you to sleep well at night. And there might be some names on here that surprise you. So get your mind right and let's get to work.
You dropped this.
Well, welcome back to another episode here of the Investor Professor podcast. Thanks again for joining me. So we look out over the market, and it's been kind of a bumpy 2 weeks. What's going on? Well, we start to look. We see that we've had, a good start to the year, good earnings from companies, and so you have these good earnings from companies, and then all of a sudden, the market kind of goes into a lull. And it's really just consolidation. I think it's a healthy consolidation, nothing to be concerned about. I mean, actually, it's kind of healthy for the market to pull back a little bit and to kind of digest these gains, if you will. So one of the things I always like to look at, and something if you're looking at some of your stocks, is if you see them pulling back, is it on high volume? Is it on above their average volume? And you can find that pretty much on any site, Yahoo Finance, something like that. Where you start to see, okay, is it a ton of people selling out? Is it high volume, or is it just low volume kind of normal activity? So a lot of it you'll see is going to be, a lot of the ones I've looked at is like on lower than normal volume, which is actually a good sign. And so we see what's going on. We've had some economic data come out. This past week we had the CPI, Consumer Price Index, followed by the Producer Price Index, PPI, on Thursday. And the numbers weren't great. They weren't horrible. They weren't, it's kind of like Goldilocks. They weren't too hot, weren't too cold. But it wasn't showing that inflation's moving down as much as people had hoped. And so we have a Fed meeting coming up this week, the March meeting. The odds are that the Fed isn't going to lower rates this week, that they're going to keep them steady. What the market is going to be looking at, though, or what is the conversation for future rate hikes? So a couple of weeks ago, the odds for a June rate hike by the Federal Reserve were about 70 to 80%. Now they're around 50%. And so again, we talked about this at the beginning of the year, is that everybody was expecting all of these rate cuts this year. And we talked about it on this show that like the economic data wasn't showing that we needed any rate cuts. The economy really isn't slowing down as fast as everybody expected it to. And so, still, holding fast that we really might not need as many rate cuts as are expected. And so maybe we'll get 2, maybe we'll get none, maybe we'll get 3. You look around and it's gonna take a little bit to see, as this data comes. But that's what you see the market kind of pricing in, basically, as you start to see the market price that in. You have the rates on the 2-year Treasury, 10-year Treasury. They start to tick back up, which means that they expect the Fed not to cut. And so when those rates go up, that means stocks are going to drop. But we'll see what happens. So we have this week, we have that going on. There's also a very important conference going on this week. Nvidia has their big conference. The name of the conference slips my mind right here. So it's Nvidia GTC 2024, and this is a gigantic AI conference that's going to be happening this week. Starts tomorrow on Monday, the 18th. By the way, 17th. Happy St. Patrick's Day, everybody. So that's going to drive a lot of the stocks that have pulled back, the Nvidias, the AMDs, all these bottle rockets we've seen going on kind of across the market over the past, 6 months. And so that's going to be a very important conference. And if that looks good, sounds good, you'll probably start seeing those names do well again and kind of touching back against their all-time highs. So definitely going to be an important piece early in the week, that Nvidia conference, followed by Jerome Powell midweek, and we'll see how it goes. We'll see how that data comes out. What I wanted to talk to you about this week, though, was go away from all the bottle rockets, go away from all the high-flying stocks that we talk so much about, and I just want to talk to you about some boring stocks. Stocks that aren't on everybody's radar, but do have done very well in performing over the past 5 years. And some of these names I consider will do well in the future. Obviously, you have to do your own research on them, but you can't. When you're designing a portfolio, obviously you need some of those names. You need the Nvidias, the AMDs, the Apples, the Amazons, the Googles, the Magnificent Seven that everybody talks about. But you also need those slow, steady, little engines those little stocks that just perform. You don't have to watch them all the time. The companies are very steady, they're sturdy, and they just do a great job performing year after year. And so I wanted to bring some of those names up, and some of them too. When I bring these up, I want you to think about the thesis of these, why I picked these names, and partly it's because they're things that people have to have that are just companies that aren't really going to get displaced very much by AI, I don't think. And so when I start naming these off, and let's just get right into it, I think you'll see what I mean. So the first two, they kind of go together. So this is Waste Management and Republic Services. So Waste Management symbol is WM, and Republic Services symbol is RSG. And so these are just companies that take out the trash, right? Waste Management, Republic Services. These are just companies that take out the trash, a service that we all need. Everybody needs it. Not going to go away. And so these are pretty steady companies. But when you look out over the last 5 years, the return on Waste Management has averaged 17.14%. Republic Services has been better than that at 19.95%. You compare that to the S&P at 13.9%, and both of these companies have outperformed over the last 5 years. They've also, Waste Management has raised their dividend an average of 8.4% on their dividend growth rate, and RSG's at 7.3%. So not only have they outperformed the market, but they've also raised their dividends steadily over each of those years. And again, these are just steady, boring type companies that continue to outperform. They raise their dividend, which acts as inflation protection for you. Later on, you can use those dividends to support your lifestyle or retire on or whatever. But these are the nice kind of companies that are able to provide that kind of protection for your portfolio. Next, we have a company that, Waste Management, I forgot to give you the prices. So Waste Management is currently trading at $210. RSG currently trades at $188. The next one, man, this is a company that I love, that has done so well for myself and my clients over the last 5-10 years. But I understand that this is going to price a lot of people out. So I'm going to say that up front, but it's AutoZone. And so AutoZone currently trading at $3,124. It's just amazing. 5 years ago, AutoZone was at, it was $1,000, but their 5-year performance has been 26.56%. So 26% on AutoZone. And this is just a very well-managed business, great management, all of the intangibles that we look for when you look for a quality management team, cares about their shareholders, cares about their employees, all the qualitative stuff about a company. If you go read one of their annual shareholder reports, you'll see what I'm talking about. But AutoZone, just a very solid business. You think about the car business, right? If you're looking at GM, Ford, those type of businesses, very competitive business. They're always competing against each other. Margins are very thin. But you look at and you think about how many cars are on the road, how many people are, have to get their cars worked on. They go in. A company like AutoZone does a tremendous job. Obviously, at that sticker shock of a stock price, AutoZone's one I wish that would split like so many other companies have done. But a lot of they've done a great job. So a couple of years ago, they spent so much money building all these distribution centers all over the place, all over the United States and Mexico. And what they were trying to basically do was anti-Amazon themselves. So they wanted to be able to basically ship you a part for your car or whatever within 2 days from anywhere of those locations, just to be able to kind of keep Amazon out of the space. And so they've done a tremendous job of that. That is just another one that is just steady as can be. I mean, just absolutely steady. Even if you look back, if you go look at a 5-year chart of theirs and you look at COVID, I mean, you can barely even see it. I mean, it's just they just steady performers. Okay, another one. Next up, we have Tractor Supply Company. So Tractor Supply, symbol TSCO. Currently at $256 a share. Another one there. 5-year return has averaged 24.79% a year. So these numbers I'm giving you are per year. And they've raised their dividend 31% over the last 5 years. So Tractor Supply Company, another steady one we have here. Union Pacific would be another one. So the railroad, Union Pacific, symbol UNP. Again, their return hasn't been as good as the market. They're at 10%, but their dividend growth rate is 11.2%. I think that over the next couple of years, they've had a couple of things happen cost-wise. I would expect their performance to be better over the next 5 years. But again, railroads, still the cheapest way to transport goods across the country. And so just a nice addition possibly to your portfolio as far as steadiness and stability. Looks good. These other ones, the next couple I have for you, I don't know if we've talked about them on the show, but one of them is Carrier. So Carrier, symbol CARR, currently $57 a share. Over the last 5 years, they've averaged 14.18%. They've grown their dividend, and they've done really well. So Carrier is the air conditioning company, right? And so you think about when you think about how hot everything's been, the hot summers we've had, so many different places around the world that are adding central heat and air. Obviously, the air conditioning piece of that is very important. And so Carrier has done a great job, steady job. Carrier spun off. So they've only been out for about the last 3 years. So basically right in the middle of COVID. So there was a merger between Raytheon Technologies and Raytheon and who's the other? Raytheon and United Technologies. And so when they came together, the defense contractors came together, they spun off Carrier, and the other one is Otis. We'll get to them in a minute. But Carrier, obviously air conditioning becoming more important all across the country. I see this as being just another business that is going to be one of those things that people are going to be, they're going to have to find the money for it, right? They're going to have to find the money for air conditioning and staying cool, and it's something that we're all willing to pay for. So I like them as well. So the next company, Otis. Otis, I'm not sure if you've ever heard of them. They're $99 a share. Otis has averaged 15% over the last 3 years. The S&P 500's averaged 8.8 over that same time. But Otis does elevators. Largest elevator manufacturer in the world. But where Otis really does well is on the service side of things. So they have all these contracts to do service for all the places that they're at. So every building, obviously you've been into an elevator, you look over, you see the piece of paper, tells you the last time it was inspected, and so that every year they got to inspect these elevators, right? And so that is just steady income, that service income that just keeps coming in for them, which is a nice, boring company. But again, it's profitable, it's steady, it's consistent, and you don't really have to think about it that much. I mean, there's not a lot of people that are trying to break into the elevator business. And so another one that we've talked about on the show is Nucor. Nucor has done very well. We talked about, I know we highlighted this on an episode, maybe 18 a year ago now. I mean, they've averaged 27%. There's companies like Caterpillar. There is some insurance companies that do really well. I mean, if you've checked on your car insurance, that keeps going up. You look at Progressive. So, their symbol's PGR. Progressive has done very well over the last 5 years. And so when you look at different companies, when you're building these portfolios or building your portfolio, you have to think about, you need obviously some of the technology companies that are doing well. They're going to change the world. But you also just need steady companies that are just going to keep doing well for you, that you don't really have to think about, oh my gosh, do I need to worry about them as far as, are they going to get beat out technology wise, or is somebody going to come and surpass them? I think about one company I think about when I think about this is like Intel. Intel stock has not done well. Intel stock has been passed by AMD, Taiwan Semiconductor, Nvidia. But when you look at, a business that is kind of, looking to do, a business that not everybody is trying to compete with, right? So when you look at waste management, you look at Republic Services, there's not a whole lot of innovation going on in the trash business. Locomotive, trains with Union Pacific, Tractor Supply Company. I mean, these are businesses we need, but they're not businesses that everybody's trying to get into those kind of industries, right? And Progressive has averaged 30% a year over the last 3 years. So, insurance companies, you look at just how to build a portfolio, and we would kind of consider this maybe a barbell, where one side is, the high growth companies that we've discussed that are in the NASDAQ Magnificent Seven, but also on the other side, you have these stalwart, steady companies that are just going to do a good job of performing for you over the years that you don't really have to pay attention to. So, not that you don't have to pay attention to them, but again, I mean, they're not, the business isn't changing on a monthly basis, yearly basis, like somebody like Nvidia, where you have this conference and there's just a whole lot of advancement at once. And so when you do that, when you build like this barbell type portfolio, you give yourself obviously the opportunity to participate in the best growth companies in the world, but you also counterbalance that with really safe, stalwart, steady, consistent companies, which allow you to be able to not have to worry so much about that piece of your portfolio while you concentrate maybe on some more of the high growth stocks. And with these, again, especially the ones that pay dividends, these are the type of companies you want to make sure you turn on dividend reinvestment within your portfolio. You want these, stocks to be, every dividend they pay, to have it go back in, buy you more shares. And that's how you get that compound effect happening, right? And so over time, that is going to allow you to outperform and to really give a nice, steady weight to a portion of your portfolio that even in times when the market isn't doing so well, these are the kind of companies that are going to buy you more shares. They're going to be around. And, when you have this kind of resurgence that we've seen in the market over the last 6 months, they perform well just like all the others. And even all these names that I've given you today, these have outperformed, and they're great companies. They have great management teams, and really all the qualitative stuff that we sometimes discuss, those qualitative measures. So many investment people only spend time on the quantitative stuff, right? Which is all the numbers, and does this ratio look proper? How's this number look? But again, the ones that really outperform are the ones who have the qualitative piece, the good management teams, steady, consistent. The customers know they're consistent. Their employees know they're consistent. Those are the kind of companies that year after year are really going to be the ones that really outperform and do a great job for you. So hope this was helpful for you. Again, I know it's not so fun to talk about boring companies, but these boring, consistent companies, man, they outperform, and they do it on a year after year basis. So hope this is helpful for you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.